Hi, welcome to Risk Management. Today's topic is entitled Financial Risk Part 3. Today we'll be looking again at fractals brought to us by Benoit Mandelbrot. Remember in the last two lectures, Mandelbrot used fractals in a variety of different contexts, ranging from medicine to geology to geography, to show us that in fact there's measures of roughness, that not all things are smooth and geometrically perfect, but rather that there's a certain degree of roughness that occurs in reality that can be modeled and mathematically expressed. Well, at the end of last lecture, if you caught it when Mandelbrot was speaking in his TED Talk, he noted that some of this roughness can also be measured in financial risk, that is, the volatility of prices that go up or down and our responses to it. Of course, that's important to us if we're in the financial realm to be able to have some estimate of risk so that we can shelter ourselves against extreme events. One of the things that Mandelbrot looked at when he was looking early in his career at fractals were cotton prices, studying the New York and European exchanges with data going all the way back to the mid-19th century. In looking at those cotton prices, what Mandelbrot interestingly found was that cotton price volatility was much more radically expressed than what would be expected under a bell curve. Remember bell curves from your middle school or high school days in statistics? The ordinary mean curve that has a certain sort of bell shape to it in the middle. If you look at this little graph I've put here, it's the lowest of the three curves. It's the one where there's sort of a nice fat mean and there's very skinny little tails at the end of the curve. And by this, I'll show you with an arrow what I mean. See that? There's those narrow tails and there's that fat median or mean. Now what Mandelbrot noticed was when he was studying cotton prices, the curve didn't actually look in terms of how the prices varied for cotton like a normal or bell-shaped or Gaussian curve, whatever you want to call it. All three are equally acceptable terms. Instead, what he found was the curve looked Cauchyan, C-A-U-C-H-Y-I-A-N. Cauchy was a mathematician. This curve that he found had fat tails. That is, the price events occurred much more frequently at the extremes than one would predict under a bell curve. And the mean occurred much less commonly than would be expected. And so the curve was skinnier in the middle, as you'll see here from the arrow, and had fatter tails than you would expect under a bell curve, as you'll see now. What Mandelbrot was estimating when he said this was that he noticed two effects in the price data he had studied from cotton. Number one, something called the Noah effect, to refer to the biblical person Noah, in which what Noah was experiencing was a flood, a catastrophic extreme event that occurred, a so-called once-in-a-generation event. What Mandelbrot noticed was that these so-called once-in-a-generation or once-in-a-century events, when it came to cotton prices, happened far more frequently than one would predict. Indeed, extreme events happened all the time, he noticed, for cotton prices. And then he started studying other sorts of events like stock price movements and so forth, and he noticed, interestingly, very similar phenomena. This Noah effect existed not just for cotton prices, but for stock prices, futures, derivatives, and all other sorts of financial instruments. In fact, as one example, Mandelbrot had calculated the odds of the stock market dropping 29.2% in one day to be 1 in 10 to the 50th power. There's not that many particles in the entire universe. That's how rare an event this would be. And yet that occurred on October 19th, 1987 in one of the great stock crashes. He also estimated that throughout the 20th century, there were about 7 or 8 of such events that were so rare that one could not actually expect them to occur that occurred on the stock market, suggesting the stock markets are not mild, but wild in volatility, to use Mandelbrot's phrase. In addition to that, Mandelbrot noticed something else about prices in financial markets, something he termed the Joseph effect, again referring to a character from the Bible, Joseph. Joseph, we recall, was the servant to the king of Egypt, a Hebrewite who had gone there and become master over many, many people. And he told the king of Egypt, Pharaoh, that there were going to be famines and plagues that were going to hit Egypt, but that there would be 7 years of feast and then 7 years of famine. And so during the feast period, the Pharaoh was to store up resources in anticipation of the famine. Notice, though, in the Joseph effect, there's a trend. There's a period of feast and then a period of famine. The periods tend to stay consistent. That is, it's not feast, famine, feast, famine, feast, famine, all in a short interval, but a long period of feast, then followed by a long period of famine. That the trend continues for some time when it's feast or famine. Mandelbrot noticed a very similar phenomenon in the stock markets. He noticed that when prices became volatile, and remember from the last curves, the Kochian curves we just saw, they in fact become volatile quite often. But he noticed that when they become volatile, they tend to stay volatile. Conversely, when prices tend to become calm, they tend to stay calm. So he noticed a stickiness to price trends. It's not like they just revert back to the mean as one might expect under a bell curve, but rather they tend to go to extremes and then stay at extremes. When the hurricane hits, it hits for a while. It doesn't just hit for one short instant. It creates multiple effects. When the earthquake strikes, there are a lot of aftershocks. And so combining these two effects, the Noah effect and the Joseph effect, what Mandelbrot showed us was that traditional modeling of stock markets, derivatives, bonds, cotton prices, and other sorts of commodities are simply incorrect. They fail to take into account the extreme events that occur with far greater frequency than otherwise might be estimated, and they fail to take into account that these events, once they occur, tend to occur with increasing frequency. For that reason, as risk analysts, we should be very interested in what Mandelbrot, who's looking at realistic data and able to model it through realistic fractal modeling, was able to produce more reliable estimates of true volatility and therefore risk in the markets than simple deterministic cause and effect models might be able to show, as was the case under the normal Gaussian normal bell curves that were used up until very recently. So in the remainder of this video, what I want to show you is a tape of somebody in Europe at the British Bankers Association exhibiting how fractal curves and fractal estimates are now used as of 2008 in estimating financial markets. This is only one individual. There are many people with different proprietary interests and rights in how they go about estimating with fractals. And remember, as Mandelbrot said, estimating with fractals doesn't necessarily allow you to predict. What it may be able to do, though, is help shelter you once the storm starts. And so let's look at this fractal video, and after that, in another class, we'll come back to, are there events out there or other causes that in fact are amplifying the frequency, magnitude, and volatility of these price effects in markets? So enjoy the video and see you in the next class.
Strategist specializing in fractal time series analysis and stochastic modeling. He has been working in the financial markets research area for 10 years, and he's advising macro clients on macro opportunities and associated risks. He's a very strong background in geoscience, economics, and technical analysis, and is going to talk us through the fascinating world of fractal analysis. So please welcome Simon Meltzer.
Well, thank you, Murray, for the introduction and for the STA for inviting me to speak here today, and to everybody for turning up to see my speech. I was going to say I wasn't going to be as entertaining as Andy Murray, but someone used the Wimbledon line just previously. This presentation will be available on my website as well. So don't worry about, writing stuff down. It'll be there. So first things first, disclaimer. Don't sue me if your investments don't work out. It's not my fault. It wasn't me. Right, there it is. This is just how I view the world. This is to share information, show what I do on a daily basis. I try to view the world from a geoscience perspective, using each market and instrument like a wave buoy or a seismic measurement system or a wind station. And then I try and consolidate all the data together to try and get reliable and consistent inferences. I'm a big believer that pending economic storms and market quakes are often forewarned in the data. That sort of visual representation, I try and view the world and look for storms. I try and be independent, proprietary, and always vigilant. I'm based in the south of France, so I've just flown in. But the one thing, I think the advantage sometimes being based out of the city is you kind of have your own space to think and make your own decisions rather than being bombarded by the endless noise that the city creates. Right. Warning, there is no holy grail for analysing or trading financial markets, but we should understand deeply how they work. The social world is a messy place. 5 minutes of scouring Google, the news, you can see all these images. I mean, we just saw it this weekend with this terrible accident with the oil tank, the tankers going down in America, and stuff is always happening. And so the same kind of things happen in financial markets, where there's humans involved, lots of humans, lots of decisions, panic, literally chaos. I've taken these two pieces from these two renowned scientists. I'll let you read them quickly just to sort of show you where I'm coming from. Anywhere, system where human behavior is involved, it's really hard to quantify. It's really hard to solve, as Stephen Hawking says. And then brings me on to Mr. Mandelbrot, who gave us the idea of fractals. Sorry. So what are financial markets? Lots of different definitions. When I'm talking about them, I'm talking about instruments, assets that are traded on an open and regulated marketplace and exchange. Places where that give you constant streams of data, not so much sort of black pool, dark pools, those kind of things. It's the bidding up and down a financial instrument or asset, individual people and now machines, more so than ever, interacting to take ownership, make profit and hedge risk. So I've come up with this simple flowchart, if you like. Financial markets, interaction of many participants, both machines and humans. That creates crowd dynamics, which you get group psychology and behavior. From this you get an emotional, unpredictable behavior. It's an organic, complex, fluctuating system, which essentially is volatility and mathematical chaos. So you watch Bloomberg, CNBC, you rarely, well, they say volatility, but generally they don't really know what they're on about. They don't really talk about mathematical chaos. You hit the news, they say it's chaos, but they don't really understand, I think, what mathematical chaos, right. That's a quick definition of mathematical chaos. The property of a complex system whose behavior is so unpredictable as to appear random, owing to great sensitivity to small changes in conditions. From this, we end up with respect to financial markets, a system with the following characteristics. Non-linear, not arranged in a straight line, not sequential or straightforward. If there's two things I want you to take away from my speech tonight, is these two things. Financial markets, complex systems, are stochastic. And stochastic's often spoken about with the stochastic indicator, but that's another story. Stochastic basically means something that's unpredictable, it moves up and down, it's random. And then the other thing financial markets are, they're fractal. A curve or a geometrical figure, each part of which has the same statistical character as the whole, in which similar patterns recur at progressively smaller scales, and describing partly random or chaotic phenomena such as crystal growth and galaxy formation in financial markets, and so on. So we'll start with stochastic. Lots of processes in life that can be recorded as a time series, basically where you've got time along the bottom, units up the side, a stochastic random up and down movement. I don't know what this is charted is, it's just stochastic. What kind of things do we find as a stochastic process? Oxford United is league position. I'm not picking on Oxford United here, it was just the first one that came up on Google. If you draw a line across there, is that a head and shoulders? Maybe, I don't know. We'll carry on. Temperature in London, stochastic, up, down, up, down, up, down, up, down. very hard to predict. There's periodic cycles where you know it's going to be warmer in the summer, colder in the winter, but to predict day to day, it's stochastic, it's very difficult to do. Economic data, unemployment rate, up, down, up, down. River discharge data, don't worry about the red line, that's just a smoothly moving average. Same kind of thing, stochastic, up, down, up, down. Wind speed, similar kind of thing, up, down, stochastic. So these are all examples of stochastic data which you can record. Wave height, recorded from a buoy, same kind of thing. If you took the scales off and you knew nothing about them, you couldn't tell what scale they were and you couldn't tell what they were, whether they're wind, water, markets. Coin flipping experiment. I was bored one day, so I flipped 1 million coins. Well, no, of course I didn't. But I downloaded it from this source. Mandelbrot speaks about this in his book, and he says, same kind of thing. The idea is you flip a coin, if it's heads, +1, tails, -1. You'd expect in the long run it should revert back to the 0, but you can see at times it goes a long way from the 0 line. This is kind of like an attractor line in chaos. This is the attractor, and it goes a long way the other side. Another 1 million tosses. It looks just the same as a stock chart, a stochastic process. Maybe even relationships could be modeled as a time series. Now this is a bit wacky, but stick with me on this one. Right, so we have the wow moment of meeting in a bar. This is probably more taken from a female's perspective. First date, or he receives a text from a female. She doesn't like that. More great dates and finally sleepovers. First minor argument. Holiday together. Bear in mind, this is time, and this is, if we could measure it, enthusiasm, feel-good factor, happiness. So finally moving together. Argument over domestic nonsense. They get engaged, feeling better. It's going up on the enthusiasm scale. Huge argument over wedding details, etc. Finally, the happy couple get married on a honeymoon. But then the honeymoon period is over. Fun DVD nights on the sofa. He forgets her birthday. Oh, the enthusiasm's going down. Buys her big flowers, showers her with gifts, and weekends away. Then the really ugly head pops its head up. Finds out he slept with the secretary. Not good. We have a massive downwave. He says he's sorry, she forgives him, make up sex, etc. More lies discovered. He promises to change. She packs his bag and sends him on his way. Divorce finalized. Now, that's a sort of, a theory I put together, but the whole idea is it's stochastic and it's very similar to sentiment in financial markets. I know Robert Precht has mentioned this in his books with relation to the sort of star status of stars. It rises, and it wanes a bit like Michael Jackson and all the, the skeletons in the closet, and it descends. So just to show something different. So many processes in life and in nature are not simple straight lines. They're not linear. They are jagged, they're complex, they're rough, a kind of balance between chaos and order at the same time. Fractals. So this is the grandfather of fractals, Benoit Mandelbrot. He was a professor at IBM. Fractals come from the Latin fractus, meaning broken or fractured. He said things typically considered to be rough, a mess, or chaotic, like clouds or shorelines. Some of the things I talked about earlier actually had a degree of order. Fractals are typically self-similar patterns, where whatever the scale, the patterns are very similar. Essentially, they're scale invariant. Also in nature, here are some examples. Lightning is fractal. Trees, river systems, mountains, waves, icebergs, glaciers, icebergs below, sand dunes, clouds, all these things are fractals. If you didn't know what the scale is and where your perspective was to these things, it'd be very difficult to know their exact size. And so fractals on financial markets. Looks, there's the mountain range, there's the market. Another picture. Don't know what the mountain is, but is it the Matterhorn? Matterhorn. There you go. I'm a geographer. Don't have a go at me for that one. Again, I just Googled. Right, so the market process can only do one of three things: up, down, sideways. As a up, down, sideways. Price rarely stays equal, as the motivation to profit, position, or hedge creates constant flux. From any point in time, price has the potential to take many different courses. So take any point in time on the stock market or in the FTSE in the day, it could do many things. So many things influence, it's a complex system. So we can define it as a random walk. I'm not going to go into random walks. There's different random walks, there's different definitions, etc. I put a bit at the bottom. If you want to see more about that, you can look on the slide. So prices can also gap down. This can happen intraday, after a trading halt, overnight, weekends, market holidays, places on the price scale where no trading actually happens. Think big events, information shocks. September 11th, the market closed. It never opened on the US market. I don't think, or did it slightly open? But then it stayed shut for 3 or 4 days, gap down. Price expansion. So this is another thing I want to really push the point. Price expansion, price is always expanding. Up, down, sideways. That's just a dots plotted of where the prices are. So this constant expansion, contraction, expansion, contraction, expansion, contraction of price. Or in another way, progress, regress, progress, regress, progress, regress. Financial markets are a bit like a game of snakes and ladders, with the board continually evolving to the right with time, up, down, up, down. Think in terms of triangles, not the traditional technical analysis triangles that we see in the books that are more horizontal based, but think of triangles of low, high, low. There's always low, high, low, high. So triangles, the market is just constantly creating triangles of all sizes. That's the fractal nature of it. You can progressively see smaller triangles. The market's constant progress and regress behavior, that is stochastic by nature, creates this high-low, high triangulation. So we've got this one cycle, low, high, low, but within that we've got lots of smaller low, high, low fractal triangulation happening. That's a quick definition of triangulation. Formation of or division into triangles. So that's essentially what the financial markets are. They're the formation of or division into triangles, fractal triangles. This process creates fractal cycles. So this is a bigger cycle, and then you've got smaller cycles. Even though that's a big up leg, there's still a triangle there, low, high, low. This process in many ways can be explained by the ideas of George Soros and his general theory of reflexivity, as shown below in the boom-bust cycle, which is popular in his book. I won't go into it too much, but essentially you get positive feedback loops that propels the market up until a point where that positive feedback system doesn't work anymore, and then on the other side you get the negative feedback and back down to a low. And in a way you kind of get that in every day on small scales, medium scales, all the way up. The triangle sort of positive sentiment, negative sentiment, positive sentiment, negative sentiment. So this high-low process happens in all time cycles. This is tick data from the S&P 500 futures. What time are we here? It's happening very quickly. Triangles between the bidding and the bid and the ask. Up, down, up, down, up, down. 3-second data. Don't worry about the volatility bands. Triangles, triangles, triangles. 30-second data. Each T represents a low or a high. If you join any ones up, you get triangles. If you join that one, and that one, you get a bigger triangle. And you can progressively obviously go lower or higher in time scale for these geometric triangles. S&P hourly data, the triangles again. Macro triangulation. This is the Nikkei over 20 plus years. There's the great bubble of the last day of the 80s. High, low, high, low, high, low. The market just constantly creates a stochastic triangle formulation. A few more examples. These from the same day. This was a intraday Coca-Cola. I mean, it doesn't happen like this every day, but the triangles are very obvious there. On the same day, IBM intraday, triangles, triangles, triangles. McDonald's, same day, triangles. Days like this are a lot easier to trade than days where it's sort of whipsaw and then up. Essentially, markets have a triangle within a triangle within a triangle and so on structure. I've used the Sierpinski triangle with a superimposed price or stochastic process, and that sort of describes how financial market works to an extent. This was, this was the expansion contraction one I showed you earlier, or the progress regress, and that was the actual section there, and all I've done is just up the scale. So that bit is the same as that bit, and the bit is the same as that bit, and it all the small parts become part of the larger, and that's what financial markets essentially are. I'm going to just introduce the fractal market hypothesis, which is a hypothesis proposed by Edgar Peters. Markets consist of various layers of traders and investors who participate at their chosen timescales. It's a bit like a trophic pyramid in biology. You've got a few second scalpers, 5-minute traders, for example, several hours traders, overnighters, swing traders, multi-month traders, all the way down to our long-term multi-year investors. The market is, part of his hypothesis is the market is stable when it consists of both machines and humans covering a large number of investment horizons, which ensures there is ample liquidity. Where one person doesn't step in, just below it someone else will step in. Market sentiment and technical factors are more important in the short term than in the long term. As investment horizons increase, longer term fundamental information dominates. Markets become unstable when the fractal structure breaks down, as investors and traders and machines at various different time horizons behave erratically. For example, when there's massive news, they don't know, what do I do, what do they do? They start panicking, they start pressing buttons, fat finger trades happen, and then they try and reverse it and double down, and all things happen. It's when these people start behaving erratically or stop participating altogether. If you take out layers of traders and they say, right, I'm not trading today, the market, I can't work it out, suddenly you get this fractal breakdown. And this is what we saw on the flash crash of May 2010. The SEC in America, Security Exchange Commission, have done a big investigation, and they reckon it started with a fat finger trade. But this shows the market depth. You can think of these all the sort of, this is obviously the bids and the offers, and these are all the different trophic layers of people that are willing to buy or sell at different levels of the market. And as you can see, as we approach this area, those trophic layers of investors, traders, people willing to be a buyer or a seller, it starts shrinking on both sides, and liquidity dries up, and suddenly the market plunges. And then it takes time for people to re-enter back into the market, and eventually those trophic layers start filling out again. More on triangulation. We all know what this pattern is. Just to show the point, head and shoulders, there's a triangle on the left shoulder, the head, and the right shoulder. It's progressively got smaller triangles if we wanted to go deeper and deeper, but just to send the point home on the most famous technical analysis pattern, that it's triangles. For anybody who you speak to, if you're a technician, and I've been in these situations many times, sometimes in speaking to hedge fund managers who run billions, or I don't know, the validity of technical analysis, just show them this chart. This is the NYSE Composite Index, essentially the world's largest stock exchange, 2006, and it's the best head and shoulders pattern the gods ever gave us. What happened? The biggest deflation in company valuations for corporate America. and the pattern, it showed it. Now I want to talk about non-traditional patterns and ratios. Have many people heard of Larry Pesavento? Anybody? Yeah? Show of hands quickly. So yeah, good, probably about 20%. So, and you've read this book, so you'll be familiar. So I'm a big proponent of his work. A lot of my work has come from him, and so I pay big homage to him. So I'm just going to talk about 3 of the patterns quickly, because it's all about triangles as well. The Gartley pattern, the butterfly pattern, the 3 drives pattern. The bullish Gartley pattern. I haven't labeled them. He labels them with A, B, C, D. Essentially, it's a sort of 2 triangle structure, and then an up, and then you just tip the pattern on its head, and it's a bearish pattern. Let's go to an example. Here we are, Eurobund on a an hourly chart. We've got a big mark down, a mark up, a mark down, and this is where our sort of trigger for a sell is on a bearish pattern. I am a big proponent of using Heikin Ashi charts. I think they're quite good at, to try and get more disciplined of waiting for the signal. Nothing's perfect, they don't always work, but that's what I've used on this chart. Now, you can add ratios. Ratios like Fibonacci ratios, expansion, both expansion and retracement. Here the market has come down and it recovers, sorry I can't really see the light there, 61%, and you've got this expansion of this triangle which is 127%. 127% is, or 1.27 is basically the square root of 1.618. That's how we arrived at. And you see 127% expansion all the times on all time frames. I don't know if it's a self-fulfilling prophecy thing or if that's, I haven't done that much research into that, but it seems to happen a lot. And when you get a cluster of 2 things, often it's a very powerful trading signal. The Dow Jones Industrial Average on a weekly basis, this is going back to 72. This is a bullish pattern. The market went up, corrected, went up, corrected, and then it went up massively. And this was largely before computers and there was all this technical analysis software that we all use was available. It's just to show that this kind of stuff was still happening back in the day. There's the retracement percentage ratios, 50% retracement, which coincided near a 161 and a 127. Bearish butterfly pattern, this is the next pattern. Where this pattern is different is the signal is higher up. Just to put it into perspective, it's kind of, there we are. Shows the sort of why it's called a butterfly pattern. The S&P 500 index created a butterfly pattern on its low in March 2009, essentially the end of the last bear market. There's the pattern. I'll put the ratios on. It's the same chart, it's just it was taken from previous work I had done. This triangle here is 127% expansion, or a negative expansion, decline. And this triangle here was a 261. And they pretty much happened within a couple of points. I'm not trying to, claim I knew this was happening, but I remember sending an email of the day with this chart to a boss at one of the future houses I was working at saying, is this possibly the low? You never know until after the event, but I should have put the email on that, but you'll have to trust me on that one. And it was just on that simple triangulation with the ratios. Another factor for this low was the commitment of traders' data. That's another story for all to talk about it, but essentially you've got commercials, large traders and small speculators. You can think of the small speculators as the retail traders, large traders as hedge funds, the commercials are the big players, the smart money. This low, if you look at the commercials, by the time we got to this low, they really upped their buying of S&P contracts. that was just another confirming factor that maybe there was going to, this butterfly pattern was going to work.
That's the large trade, not commercial.
Sorry, was that the... You are very right. You're right. There was an yeah, completely right. There was an uptick as well on the commercials as well, but it doesn't look as significant as the large traders. Another butterfly pattern, US dollar index in 1992. I haven't got the ratios on this, I don't think, but essentially I just want to send home the butterfly pattern. Hopefully, if you haven't heard about these patterns, you might start seeing them and think, is that a butterfly pattern or is it a Gartley pattern? There is an element of subjectivity to it, but it's just another way of looking at the market. This was a bearish butterfly on BlackRock World Mining Trust. I remember the market at the time going up, and I was thinking, you know, everybody's so keen on resources and metals and mining, but there's a butterfly pattern. What does this mean? I wasn't aggressive like I should have been with it. I didn't trust it enough, but as it turned out, it was a very powerful signal. There's the ratios installed. And always sometimes you have to have a bit of subjectiveness or subjective analysis of where you take the count from. Do you take it from the top of the candle, the spike, or do you take it from on a regular candlestick? Do you take it from just use open and closes? Sometimes you have to play around the two. It's not an exact science. So anyway, going back to this, we had 127 expansion from there to there, and we had a a small 127 there. I've got the triangles on another graph at the time I did. You had 3 triangles all saying this is potentially a powerful butterfly pattern. Oh, there's Oxford United again. Is that a butterfly or am I just being fooled by randomness? I don't know. But anyway, there we go. The final pattern that I'm going to talk about is the 3 drives to a bottom pattern. 1, 2, and 3, or alternatively 3 drives to the top. 1 push higher, 2 push higher, 3 push higher. This is very similar to the ending diagonal in Elliott wave theory. 1, 2, 3 for the 3 peaks to a top. So Eurostop Banks example, 2007, 1 push high, 2 push high, 3 push high. Potentially a powerful signal. There's the ratios on it. I won't go into those. You can view the slides afterwards if you want to go. But this is just to sort of support the ratio analysis if you want to do it. 3 drives to the bottom for the S&P Global 1200, which was happening at the same time as that butterfly pattern that I showed you on the S&P 500. Knowing all these patterns can give you more confidence that maybe you are making the right call for yourself, your clients, etc.
So there you've seen an example of an individual who's taking fractal patterns, looking at certain zigs and zags and triangulation as his starting point to create fractal models. It's not necessarily right or wrong. What he's saying is, I see in the data trends a certain triangulation pattern. And knowing that, I'm going to build fractal models around triangle patterns to try to predict ups and downturns in the market. Of course, the question is, does your computer program actually reflect the trends in the market? It looks like it on the surface. I can build computer models that are indistinguishable from and can trick the ordinary person into thinking they are real price series. The question then becomes, are they accurately depicting existing price series? And that's where the secrets, if they are there, are usually not revealed publicly. How people do this and how they try to make money off of fractals. In any event, an interesting lecture. Look forward to seeing you on the chat boards with your thoughts about your proprietary interests in this.